Hey everyone, this is Rahul with the Alternative Investors Hangout, and today we have a returning guest. He is Jordan Trentzman, and he's a newsletter writer. Thanks for coming on again, Jordan.
Hey, Raul. Thanks for having me. It's my pleasure.
All right, so I just wanted to look at the gold and silver market. I think we talked back in May, and it just seems like the gold and silver market have stayed constant. I know for gold, I don't remember the price of silver then, but number one, what do you see happening, let's say, in the gold and silver market? I mean, we see Paulson and we see, what's his name, Soros. I think they made huge bets in gold. I think Soros invested a lot in the GLD. I don't trust paper, but that's what his bet is. So what's your take on that? Do you see, let's say, a push for higher gold, especially with the debt ceiling, let's say, coming in the next few months, or what?
Well, as you know, the market is a discounting mechanism that discounts things in advance. And there's a couple reasons that I want to go over why I'm fairly bullish in the short term. Now, a couple of weeks ago, we had, of course, the Fed and the ECB. Well, the ECB was, of course, jawboning the market. The Fed, they leaked some things to their reporter at the Wall Street Journal, Hills and Rath, who's the official Fed mouthpiece. And so he leaked a few things, and gold had a few good days. But coming out of both of those meetings a couple weeks ago, there wasn't any new policy, any new actions. Yet on top of that, the precious metals markets rallied pretty nicely. So you could kind of consider that disappointing news, yet the market rallied. Now, at the same time, if I can just bring in the mining shares, the three big companies that comprise most of these various indices, the XAU, the HUI, GDX, etc. You have Goldcorp, Barrick, and Newmont Mining all had terrible earnings reports, yet the gold stocks failed to make a new low. And so normally you would expect bad earnings reports from the most important companies, the most largest and liquid in that sector. If you see bad news like that, yet you see the market not reacting negatively to that, as we saw, it's very bullish. So given these things, the market was able to not make a new low and kind of rally a little bit. And so, looking at the metals, we've kind of been stuck in a range. I actually thought a few months ago the metals, a few months ago, the metals looked to me like they were going to break a lot lower because they failed to rally. Now, I'm going to get redundant here, so bear with me. It looked to me like the metals should have broken lower. I mean, they were at that support. Sentiment was really bearish. And, a lot of people, including myself, felt like, we should see a pretty strong rebound. We didn't get that, so then I was thinking to myself, well, maybe they're going to break lower, and we need to see that to get a washout. And that didn't happen. And so, what we've seen recently is a real lack of buyers and sellers in both gold and silver, because the both markets failed to break lower when they should have, and at the same time, we're not seeing enough buying to push them a lot higher. Now, let me get back to today. I think the last couple of days, the action in the shares is really encouraging. And as you probably know, the shares lead the metals at key turning points. And so in the last week or so, we've seen very strong relative performance from the shares, especially today and also yesterday. And so the action that's going on in the shares tells me that we're going to see gold very soon, should push above 1625 and perhaps rally up to 1740, 1750. In regards to silver, I haven't been following that as much just because gold is more important and silver usually follows gold. But looking at silver, I do expect silver should probably push up to 30 in the next 1 to 2 weeks, and perhaps over the next month or two, kind of get up into the 32, 33 area where it might find resistance. And the last point I want to make about gold, if you look at the COT structure there, the open interest in gold has been falling. And so I mean, it's been continued to fall for quite a while, and so that means there's a real absence of people in the market. I mean, in addition, I mean, everybody knows that the commercial short position is at a 3-year low, but in addition to that, open interest has been coming down substantially. So the sellers in these markets are essentially gone, and I mean, what we have now is, or what I should say, what we've seen in the last couple of months is it's just taken some time for these markets to find a base and for buyers to come back. And so I believe because of what we're seeing in the shares, I think that's telegraphing that we're going to start to see higher prices in the short term in both gold and silver.
All right, you've made a lot of points there, but you mentioned something about, let's say, Newmont Mining, and I believe it was either this year or I think maybe last year, the high was in the low 70s, around that range. And right now I think Newmont Mining is at, like, say, $46 a share. But what I'm trying to get at, though, I mean, we see this huge increase in the price of gold, let's say from 2009, and the shares pretty much haven't gone up that much. So, number one, why do you see, let's say, the prices of shares not correspond with the increase in the price of gold? Is it because there's a lot of paper ETFs? I know there's market manipulation, but there's always market manipulation. But if you look in the 1970s, the price of shares went berserk. So what do you think is going on there?
Well, actually, I'm just trying to figure out where I can start, because there's I think the explanation for this is there's really a number of different things. I think you made a good point there about the proliferation of these ETFs like GLD, SLV, and the physically backed ETFs. That's definitely taking some capital away from the shares. But if you go back to the 1960 to 1980 bull market, the shares actually, other than the first 8 years or so, and the first 8 years or so, the shares performed relatively well against the metal. But you know why? It's because the price of the metal was fixed. So if you look at, from the late 1960s to 1981, even though the shares had really good rises, as you say, they actually underperformed consistently against the metal. So what we're seeing in this bull market is actually it's repeating what we saw in the last bull market, and that's something that I think a lot of people really need to research, because everyone just assumes that because the shares are performing so badly, there has to be some manipulation, or something's going on that shouldn't be. But the reality is the same thing happened in the 1970s, and I think we're going to see that happen again. I think it's just a very difficult business. And the larger companies get, mathematically, it's just very difficult for them to grow. I mean, if you're producing 3 or 4 million ounces a year, I mean, there's not a lot of mines out there that can produce 500,000 ounces a year, or even 300,000 ounces a year. I mean, that would just be a 10% increase in production. So it's just mathematically impossible for these large companies to grow. And then on top of that, you add in the fact that it's a difficult business with political issues, permitting issues, cost overruns, management ineptitude in some cases. I mean, I think if you look at all those things, and also another reason is we've seen valuations come down in the sector. Now, I went back and I looked at various bull markets in the last 100 years or so, looking at the bull market in the Dow from 42 to 66, and then in Japan from the late 60s to 1990. And of course the Nasdaq and the tech bubble. Now there are the gold stocks currently are actually following a similar pattern. Now you can break down a bull market into 3 phases. You have the first phase, which is a stealth phase, and then you have the last phase, which is kind of where everybody starts to come in at the beginning of that phase, and then it turns into a bubble. Now the middle phase is a wall of worry phase, which begins with the first big correction, which is 2008. If you're looking at the Japan bull market, the first big correction was there in the mid-70s during that terrible recession. If you look at tech stocks or the Dow in the 80s and 90s, first big correction was 1987. The stock market crashed. Now, after that, what happens is it kind of begins a wall of worry phase, and essentially the appreciation in prices is not as fast and not as large as what you see in the first and the third phase. Yet companies are still making money to the degree that they were in the first and the third phase. So in other words, in this middle wall of worry phase, you have companies continue to grow their earnings, yet investors become more pessimistic, they become more scared, so a wall of worry builds up, yet at the same time, prices don't rally as much, and so therefore you have valuations tend to come down, and that's what we've seen. I mean, if you look at, for example, PE ratios, I think 2005, 2006, the HUI was trading at like 30 or even 40 times earnings. Now I think it's 12 or 13 times earnings. So I think what tends to happen in a bull market, I think people are they're losing sight of essentially, what's happening with the gold stocks is somewhat typical of what we've seen in past bull markets, and until the gold stocks break to a new high, which I would probably guess probably happen sometime next year. I mean, then after that point, that would launch us into the third and final phase.
All right, you make really interesting points, Jordan, but I wanted to get now into this topic of this U.S. Treasury market, and I've noticed that, number one, this Treasury market, I think, went as low as maybe 139 or maybe 140. I don't remember. It was around that range. And then the last few weeks, I just see the T-bill market, the 10-year especially, it continues to go up every day I turn on CNBC. So I know a few things have happened. Number one, I believe Paul Ryan is now, let's say, Mitt Romney's candidate or vice president candidate, and it just seems like they're going to cut taxes, which initially will be good. They're not going to cut enough spending, which is not a good thing. But what I see happening is you may see, let's say, the economy start to recover with the Romney administration as well. But what I'm saying is, do you see, let's say, number one, no recession occurring, and two, do you see, let's say, the bond market signaling that you may see a new administration next time around? Your take on all of this?
Well, getting into I don't really think, I think people kind of overplay the effect of politics on the markets. I think that unless we see a big sell-off in the stock market, which is probably not going to happen, I think it's pretty certain that Obama's going to get reelected, and I'm very strong in that opinion. But that's a whole nother discussion. I mean, that's just my take on the situation. I think he's running a much better campaign. He's hitting below the belt, and all those types of things. And I think in the swing states, the unemployment situation in some of the swing states is better than it is nationally, and so I think that's really going to help Obama. And so anyway, I'm pretty confident that that's going to happen. Now, looking at the bond market, let's go back. As far as a recession, that's a really tough call because there's a real conundrum going on. Recently the bond market has if you look at the bond market and also commodities markets and emerging markets, they've basically priced in a mild recession. Yet the S&P hasn't priced in any of that. I think part of the reason could be because a lot of money in Europe has come into U.S. equities and U.S. bonds as kind of a temporary hiding spot during this Euro mess, which I think this Euro mess is going to start to subside, but that's a whole nother, that's a whole nother answer. But, looking at the UST, the 10-year Treasury note price, it appears to have made a double top in the last couple months, and we've seen a pretty big sell-off in the last couple weeks. And so, if I could do a little quick charting of that, we closed at 131.5 today on the UST. I think that could probably continue to fall, probably down to 128 or so, and at that point it would probably find some support and rebound a little bit. So short term, I'm definitely bearish on bonds. I expect yields to go higher. After that, it's kind of a difficult call. But Yeah, that's kind of my thoughts there on bonds and the political situation. I wouldn't consider myself an expert on looking at how politics affect the markets. I mean, that's just my opinion. I think people kind of make too much of that.
All right. Speaking of these interest rates, I mean, there are a lot of, let's say, libertarians like Peter Schiff and a lot of the guys probably that you follow and I follow continuously saying that we're going to have hyperinflation. And I am seeing these yields rise. I'm not worried about yields right now. But if we continue to add all this debt, do you think that we're going to, A, have, let's say, a 1970s situation where the dollar just depreciates, we get higher interest rates, or are we in a situation like Japan where we're just going to have financial repression because the Fed's going to monetize all this debt and, let's say, kick the can down the road probably to another generation that will have to face lower living standards? So what's your take on all of that?
Well, I don't think we're going to have hyperinflation. I mean, that's really an extreme prediction, and people have to look at how that happens. And it's just there's really no way that's going to happen in the U.S. Now, I definitely think at some point we're going to have some kind of debt crisis because we actually have to refinance or roll over 59% of our total debt just in the next 3 years. I'm sure there's similar statistics. I don't have them right with me right now, but there was a great article on Financial Sense maybe about a month ago, essentially talking about how much debt monetization globally will have to occur in the next several years. It's not just the U.S. These other countries have to roll over and refinance a lot of their debt. So, I mean, that's definitely going to be inflationary, in my opinion. As far as the hyperinflation, I really don't see that happening. I mean, it's interesting because, when people get scared, a lot of money moves into the bond market. So that's kind of beneficial for us wanting to, handle the deficit problem. Yet it's kind of when things get better and we see a little recovery, then that's when money is going to move out of the bond market. But as far as a debt crisis, I definitely think we're going to have some debt crisis at some point in the next probably 2 to 4 years would be my guess.
All right, Jordan, before I let you go, how can people, number one, follow your own work and then maybe subscribe to your own channel or to your newsletter?
Well, they can go to thedailygold.com. You can also sign up for my free newsletter there, which is an easy way to follow all my work, and also have a premium service, which there's a link on my website for that.
All right, thanks for coming on again, Jordan.
Hey, thanks for having me.